All right, we seem to all be there and ready to go. So let's get started at the top of the hour. So hello everyone and welcome to Truflation Inflation Analysis for April 2023. We'll get started as usual with Oliver Rust, who will provide us with the Truflation analysis and the rationale behind it. Then both Stefan Rust and Ivan Jelik will discuss the analysis as well, and then we'll open the Twitter space to a Q&A. So before I hand out the mic to Oliver, I will get it started, of course. I just want to remind everyone to be courteous when you have questions during the Q&A. Make sure that you ask to be a speaker if you have questions during the Q&A. And if you don't really want to be speaking, but you still have questions, don't hesitate to tweet at Truflation, and I'll be monitoring the feed to make sure that those questions are being asked. Send the questions anytime. I'll ask them as we go. Quick note, we had some issues on the last Twitter space regarding speakers who couldn't join even though they requested. It seems like it was a new bug from Twitter. It came from their site. So hopefully it's all resolved now and we'll have a nice and smooth space tonight. So thank you everyone for being here. And Oliver Rust, when you're ready.
Thanks a lot, Aurelian. So just as a follow-up from last month, I thought it'd be good just to give everyone a quick recap of where the month landed, and then share some of the trends that we're seeing through the Truflation data, and then end up with some Q&A and some forecasting abilities as well. But I think the major takeouts is more just to focus on the trend lines. We'll give you obviously our predictions on the marketplace, but I also want to highlight to everybody here we're increasingly having other people utilizing the data to predict, although we're predicting as well. And so it's always great to get a consensus of what everyone has got a viewpoint on the prediction. So during the call, if you happen to have an alternative view, please do reach out, as Aurelian mentioned, ask for a request to speak, or share your views with us as well. We're keen to get as much input as we possibly can, and then we can always progress from there. So let me start off with a bit of a background. As you all know, the inflation numbers, according to the BLS, were in January was 6.4%. It got reduced down to 6% in February. The Fed increased interest rates in the March meeting by 0.25% or 25 basis points. And even though that the inflation is running at 6%, they still went up to 25%, regardless of the financial stability concerns that they had. And the question, of course, now is what are some of the trends that we're seeing in the month of March and also going more recently in April, and what that forecast is looking more longer term and the impact that has. What is a bit worrying, at least from our side and our perspective, is that we believe that inflation is not a transitory element or a transitory situation. It is very much here to stay. And we're starting actually to see month-on-month increases or daily increases on some of the indexes that we're producing. You can see on the website at www.truflation.com. But in the April numbers already on year to date, we're starting to see increases from March and from previous months as well. And in particular on some of the indexes, which we'll go through as we go through the call. So what is all this meaning? We're seeing a downward trajectory from at least what the BLS is reporting. But they're having still month-on-month increases on their index numbers. But on a year-on-year basis, they're seeing a downward trajectory. And we would expect nothing less than that downward trajectory to continue in the month of March for what the BLS is projecting at. And there are a number of reasons why that is the case, despite that we're seeing some uplift in our numbers to have more of an accurate reflection and a more real reflection of what's happening in the marketplace. The drivers of why we would expect the Truflation or the BLS numbers to drop down and also what's happening in the Truflation numbers are as follows. The first one is utilities, health, communications, and education. We're seeing a downward trend. And if you take out the bigger ones, let's say utilities has dropped 1.5% month on month versus the month of March versus February. And despite it being a 6% of household expenditure, a relative importance of utilities on household expenditure being 6%, it is mainly driven by things like the commodity prices, be it oil prices, be it natural gas prices, coming down in the month of March, and that has fueled the reduction in those prices. However, I would say if we're looking forward, we have seen in the April numbers already year to date, so we're halfway through April, and already some of the numbers already increasing, right? So natural gas is pretty much flat versus where it was marginal increase from this time a month ago. But if you look at oil prices, they're going up again, right? And that's going to impact then potentially future prices of commodities, in particular fuel oil costs that are being experienced by the households. I think on top of that, which will also affect transportation costs, which come to later on, but on top of that, the most recent OPEC announcement about restricting supply and also the increased demand from markets like China on oil is likely to see an increased price of the oil futures market, which will in turn, no doubt, affect consumers all around the world. The second category that we're seeing a decline on, or have experienced a decline on, is on health. And I think part of it, we're seeing a marginal decline in health, an actual decline on health, where we're seeing a decline of 0.2%. And that, although it's an acceleration of that decline from the previous month of 0.1%, it's in part driven by the drop in insurance coming off a massive high of cost of insurances in 2022. And second of all, coming across a decline in medical services. So that's on the health. Those are the two drivers around the health. Looking at some of the other categories, in particular communication and education, although they have a smaller impact on household expenditure in terms of the relative importance, we are seeing actually not a decline in these, but a slower rate of growth. But what is interesting actually is in education, again, we're starting to see an increase versus the previous month. So if you look at month on month, the rate of increase is accelerating. And that combined with a few of the other indicators that we spoke about, which is around utilities, it does seem to suggest that certainly inflation is not transitory and is here to stay. I think there are three other categories that I wanted to mention, which is one, I don't think we're out of the woods yet on inflation in terms of coming down. One of them is housing costs, right? Housing month to month, as for what Truflation is reporting, is up about 1.2% month on month. We're seeing the mortgage rates, or the 15-year or 30-year mortgage rate loans, starting to drop in the month of August, and that drop is continuing in the month of April. Whether this is on owned housing or rented housing, we're seeing the same trajectory. And what we're also seeing, specifically around owned housing, is the number of new sales in the market, month on month, has been accelerating. So it's been increasing for the last 3 months, month on month, from something around 550 or 550,000 in the month, I think it was in December, to now in January hitting the 600 mark, and in February hitting the 650 or 640,000 households sold. And that acceleration is continuing. What is also dropping is the number of new houses on the market, i.e. inventory levels, are starting to come down month on month. And what we're also seeing is the average prices are up. So despite where we've seen the decline in the last 9 months on the housing, we're now starting to see a reversal of trend with the drop of the mortgage rates. And that's no doubt going to fuel potential demand again as we move forward. The other thing to be mindful of is food. And if you look at our food index, obviously month to month, you're seeing a downward trajectory. I think we need to offset that with a couple of things. First of all, food is broken down into food out of home, as well as food in home. So in-home food is grocery shopping. Food out of home is obviously dining out. And we're seeing a significant downward trend on dining out, whether people are downgrading or reducing the number of times they're going out, versus the growth in grocery trading, in grocery prices. And there we're seeing a significant stark increase in those prices. And whether that's a result of, we're starting to see sort of a rebalancing of supply-driven cost increases that were there pre the pandemic level, so to speak. And then post now, we're seeing them being gradually replaced with other costs, such as labor cost increases, finding talents, wage increases, the increased transportation costs, so more of a logistical costs. we're starting to see those elements increasing as well, and therefore driving an increase in prices of those products to consumers. We have yet to see any sign of those prices abating, and so we suggest that we're expecting those to continue and to keep more of an upward pressure on inflation as we go towards the latter half of the year. Beyond food and housing, there's obviously transportation costs, and in the total transportation category, what is really great is to see is that there's overall downward trajectory on all the transportation costs except for one, which is gas prices on the pump. This is driven by higher demand and also tighter supply. And again, coming back to the OPEC comment I made earlier, the trajectory for that, looking longer term, at least in the next 3 to 6 months, is we're starting to see already an increase of the gas prices at the pump. In the last month alone, I think we're looking at an increase of around 5 to 8% in the last month alone. And then that's gradually going to increase, could have the potential of increasing further with results of the OPEC and that recent announcement for OPEC. And then I think just a final side comment just to make is on apparel. On the apparel industry, yes, they're starting to see significant increases. And part of those increases, yes, there's the usual supply chain issues I mentioned earlier, the logistical issues, transportation costs increases, labor cost increases, and so forth. But I think there's an additional element in the apparel industry, which is the import tariffs issues. And that is also causing an increased cost of the prices that the brands and retailers of the apparel industries are being forced or squeezed into a situation where they have to look at an alternative of increasing prices. So where does this all leave us for the long-term outlook and the short-term outlook? Look, for the short-term outlook, what are we, based on all the data that we are seeing, and there are others that are utilizing our data to predict the forecast of the BLS, but we're expecting them to drop down to roughly 5.3% year-on-year change of all goods and services, and that's a drop from around 6%. It's in line with a lot of the market expectations. They're coming down to 5.2%. And others have come down even lower than 5.3, what we were predicting. So that gives you a bit of a range. But I think much more, if we look at the trends that we're predicting by category, what are we thinking the long-term view is? And the long-term view is, that, in our viewpoint, is that inflation is certainly not transitory. It's going to be here to stay. And it will come down a bit more. And then as of next month and the months ahead, we're starting to see certain key categories come down. So we expect the housing market to drop in terms of the BLS reporting, which will have a significant impact on the future numbers of April and May and June. But longer term, I think the inflation number will not disappear. And we're expecting somewhere hovering around a 4 to 5% by the end of the year. So on that note, I'm going to open up to Stefan or Ivan if they have any additional comments or any flavor they want to add, and then we can go into the Q&A.
Yeah, hey everybody. Super good day, at least for all of those active in the markets. But I think just a couple of things, right? This week is a big week. We all know that on, tomorrow we've got the announcement associated with CPI, and everybody's anticipating that. Oliver just revealed our sort of, based on the data that we have, what we see. And also our community has been working with our data to calculate a whole bunch of numbers. And going forward, we're very much going to work with the analysts in our community that use our data to try and forecast the numbers. That said, we will still provide a whisper number that we think is where the Fed will come out, or the BLS will come out. And ultimately, what impact does that have in the economy? And so we're sort of seeing a 5.3, whilst the market is still expecting a 5.1, 5.2, depending who you talk to. And some of the analysts, like DCPI, who is working with our data, is forecasting a 4.9. And so we have quite a range, but it's a significant drop from the 6% that we are currently, which the official number currently is. However, still way above what the Truflation CPI is, or the true CPI, which we're having at 4.3%. Oliver's gone into that, but we've got a number of other additional data metrics that are coming out. On Thursday, you have the producer price index, which is what is the production price. We have the jobless claims. How many individuals are claiming for jobless? That comes also out on Thursday. So you have two big metrics there that will influence the demand side inflation or consumption in the marketplace. And we think that the Fed is going to be looking at how strong is still the demand. I think they're not so worried about supply chain, the cost in increasing in supply chain, as that has sort of moved out of the ecosystem, but it's more demand side, right? And so the jobless numbers will also matter. The PPI coming out on Thursday as well will also matter. So Thursday is going to be a really big number. And then on Friday, we have retail sales. So how much is being pulled off the shelf? What are those metrics and how are they performing? Is retail moving up or coming down? And on top of that, we also have the production. How much is being produced on the ground, right? Is there a lot of production? And then what and how is that impacting inventories? If retail sales are down, inventories should be going up, which means unit costs will be coming down, and then we will be seeing sharp discounting. And if you look at what happened with Tesla, Tesla saw a growth in sales numbers. However, as a result of piled up inventories and discounted rates associated with the cars that they were selling. So there has been, and there is this week, going to be an important element around how the Fed is going to react in May, in their May meeting, when they decide around interest rates. And then, as Ollie mentioned, the forecast at the moment is still that these interest rates are going to go up 25 basis points. I think it's too early to tell. I think we'll see where that comes out, because there's another index, even more important, that comes out again, which is what is the consumer sentiment. University of Michigan reports a consumer sentiment metric, and that comes out again in April. What we're working on at Truflation is trying to bring these metrics and make these visible to you, and a trend analysis associated with the historicals associated with each one of these items. And they will be coming to the Truflation dashboard. And that's why we are now so much more aware of all of these different indexes that ultimately influence the performance of the economy and the measurement of the economy. How can you then begin to extrapolate based on 10-year historicals into the future of what sentiment's going to be like? If sentiment's going to be bad, people are going to be spending less. That means inventories are going to be going up. That means retail sales are going to be coming down. That means you, as investors looking for alpha, can then ultimately be able to predict what and where can you place your bets, and you do your own research based on the data that we provide on what insights you might have in the macroeconomic environment. And ultimately, we're trying to provide you with better tooling to be able to make financially literate decisions and find and seek the alpha.
Hello, everyone, and thank you, Stefan, for this. I just wanted to touch on a few points that both of you guys mentioned, starting with the Oliver's kind of intro that and what is probably going to happen with the inflation or the CPI index in the next few months. And as we see what's been happening this time last year, where we had really huge spikes or increases in the prices across the board, across multiple categories, we can see that increase still happening, but with a much lower rate. So this is where our opinion that the inflation will slow down in the next few months, and this month will have from 0.7 to according to some even over 1% of a drop of the inflation, the headline number, which shows the direction where we are going, but also it shows that even the inflation is slowing down, the prices are still continuing to go up. So if we remember from the last conversation or from the last spaces where we mentioned that Fed have actually three things to look for, and inflation is one of them, unemployment, and then we have the financial stability. If we can say that inflation is finally, under quote marks, stabilizing or dropping, we can see on the other hand that the jobless claims are again starting to go up. So this is a metric that was quite stable and favorable for the Fed, and they didn't worry too much about it. But in last few weeks, we can see an increase of 10 or 20% of jobless claims on a 4-week average, and something similar on the metric called continuing jobless claims, where we can see that the unemployment is starting to go up, which is tying to what Stefan mentioned, that interest rates will potentially continue to rise for 0.25% during the next meeting, because even though one metric, inflation, is stabilizing, the other one, which is related to unemployment, is starting to pick up in a negative direction, of course. So that leaves us again with the financial sector that seems has been stabilized for the past few weeks. So no bank runs, no bankruptcies happening, which is definitely a good news. Even though we still see that the money from the banking sector or within the banking sector, financial sector, is moving and shifting the allocation of the assets, and people removing their monies from the bank accounts into other places where they can get better yield, something similar to what you have in crypto in term called yield farming, where you actually just go where the yield is higher, which we didn't see happening in the banking sector until recently, but we can see it now with the huge interest rates hikes. We can see that people are starting to look places where they can actually earn more than 1 or 2 basis points that they get at for big banks in the US. So this is where I see things happening if you look at it from the a little bigger perspective than just focusing on inflation and unemployment. If we take into consideration financial sector and what might happen, 0.25 seems like a realistic option.
All right. So we can move on to the Q&A. If anyone has any questions, please do send me a request to be a speaker. In the meantime, if Stefan or Oliver have any comment on what has been said, feel free to jump in. And as soon as I get requests for speakers, then I'll open the mic for you.
Yeah, I mean, I just think that, you know, sort of one thing that we've seen is that the public figures always seem to be behind the actual reality, and, you know, as a result, changes in inflation rates and the announcements that get made have a lagged impact. And we've seen that across a lot of the financial services and a lot of the different industries. We today live in a very modern, fast-moving world, and ultimately what we're trying to do is try and access a lot of this price information faster, quicker, and make that visible in the Truflation dashboard. So we try to balance out what that means historically, what the price changes have been, how can we then help make that forward, and, we're just seeing a lot of these metrics a bit ahead, which allows us to then look back and sort of give us a better perspective on what could be the outcome with the announcements that the governments are going to be making. Yeah, I mean, a lot of announcements this week. So I think this week will be really critical. We've seen Bitcoin move up to above 30,000, and largely that's in anticipation of a low inflation rate. And the drop from 6% to 5.3%, or whatever the outcome might be, is a significant drop. And and people are hoping for that drop, because ultimately the more drops and the more data that comes out this week will play in positively towards will have a significant impact to the inflation rates that's going to be decided in about 22 days when the FOMC meeting comes together. And so we should see a negative week in the economy, which has a positive outcome on the interest rates, keeping and possibly even having a 25 basis points interest rate hike, or possibly even no hike. And it's sad to see that we actually have to hope for negative economic data in order to see a positive outcome around interest rates decisions, which ultimately will then allow the capital markets to know where the economy's at, and ultimately start placing bets accordingly based on the specific outcomes. And there are a lot of activities going to take place this week based on these numbers that are coming out in anticipation for the May announcement.
All right, so we have a question coming in. Tom, when you're ready.
All right, thank you. First of all, I would like to say thank you to Truflation for the awesome podcast. It's really helpful. So I have two questions, if you don't mind.
No, go ahead.
Yeah, my first question is, I noticed that the past CPI data hadn't really affected the market that much compared to how it did last year. So I'm not sure, I'm a bit confused. Do you probably have any idea why recently the past two readings of CPI do not really give big impact to the market? And then my second question is, just now you were saying about the huge economic data this week. I think we shouldn't forget that we have big banks earning this week as well. So I read many tweets in the Twitter of people saying that this could be the trigger, even a bigger trigger than those economic data. So how do you feel about that? Thank you.
Thank you. Who wants to take this one?
This is Oliver. I can take the first stab and then pass it on. So first of all, thanks a lot for your call, for your question. So I think why the CPI number hasn't really affected the markets in the past, I think people have been baking in certain reductions. I think there was a bit of a surprise in the element when the January number didn't come down as much as it should, as expected, versus December. So if you remember, the BLS announced in December was 6.45. And then in January, it came down to 6.4. And so I think that was a bit of a shock to the system. But I think since then, with the BLS number coming down to 6 last month, and then hopefully expecting to come down a bit further, in the February forecast, I think all that is baked into people's assumption of what's happening. And I think what will be interesting, as Stefan mentioned, all this other economic data that's coming out, how the Fed will react. People are also assuming that the Fed interest rates are going to be starting coming down this year. And I don't think there's any misalignment of there being potentially one or two or the minimum being at least one price interest rate hike decline this year. The question is just when and to what extent. Does it go further than that? And you know, the views of Truflation is that being that inflation is here to stay, and so therefore what the forecast is and what the likely outcome is going to be significantly different to what the market is expecting or has been predicting in the past. As for the second question on what's going to happen on the economic data and what the Fed's going to do with it, if I interpreted it correctly, like I think the economic situation in the marketplace in the U.S. economy right now, with all the data sets coming out and how the Fed is going to react and what's going to happen, I think we have a call set up for that early, I think just before the FOMC meeting results are announced. So I think the Twitter Spaces we've arranged is on the 2nd of May, I think it is. So please come and join that. And a lot of the outcome on there is going to depend on a lot of the data points that Stefan has mentioned, because inflation and labor movements, the price movements, inflation movement, the price movement, labor market, and the financial stability are the top concerns of the Fed. But I will say that based on track record of the Fed and what Jerome Powell is coming out with, they're likely to stick to their current track unless something dramatically changes on that. So this week's data is going to be critical to see how and what impact that will have on the Fed decision-making process. Stefan or Ivan, I don't know if or Raylene or anybody else is going to comment, please feel free to tap in.
Well, I would just like to reiterate and confirm that what you said. I also believe that the prices or the sentiment has been baked in already. It's been priced in. So if you look at the past predictions of the CPI and where the actual number landed, you will see that all of them were within those ranges. And the predictions or forecasts were pretty accurate. And why we've seen big changes last year, this period, is the forecasts were really off and people didn't know what to expect. So once the numbers got out, people were caught off guard. So they needed to go and rebalance their portfolio according to the new information they got. But it seems to me that the forecasts are becoming more and more accurate, and the behavior or the numbers that come out from the CPI has become more predictable. But that doesn't mean it will happen every month. So we need to see what they're going to say tomorrow.
Yeah, I mean, also remember that in January, the BLS announced a change in the way that they were going to weight and calculate the CPI numbers. And I think partially that might have played into the mismatch between what the market was expecting and what the actual reality was. Number one. And number two is, I think the market is still and was still trying to get a feel for that differentiation. How big is that? What impact is that having? And as a result, was not so sure how best to react according to that mismatch that we saw expectations to reality. And hence the market didn't move as much as based on the fact that it was different to the expectation. I think this week your observation, the banks are going to be announcing their results, and I think you can be pretty sure to assume that those results are going to be negative or pretty costly. Their cost of capital due to the federal staking service that is there, where you can stake your hold to maturity securities. You can hold them there, and the bank will give you a 1-to-1 in advance to that. That cast a couple of that capital cost is much higher and is costly, right? And so whilst they can have it for a year, they're going to have to accumulate costs in their P&L associated with that. So I think the question is, Jamie Dimon saying that those banks are all secure now and it's not a problem anymore. Whilst that is a strong affirmation, but we all know what happens and what people say in advance to an activity like that, right? You can see, quickly that announcements like that result largely into, it's like Sam Bankman-Fried or Do Kwon in the crypto industries. They said, we're okay, we've got everything covered, your money is safe, and then you never know, right? I mean, their whole intention is to make sure that the market is confident, trust does not break, because it's really only a question of liquidity more so than anything else. And the banks are most likely solid, but they don't have that capital in liquidity available when you have $45 billion in requests in a single day. How do you handle such volume? Or in the case of a Credit Suisse, 100 billion within a single day. How do you handle that volume of demand in liquidity? And that puts a huge pressure on a lot of these financial institutions. And so now, thanks to the FDIC saying they will handle on a case-by-case basis, they will back all the depositors, number one. Then number two, this loan facility or the staking facility that the Federal Reserve has put up, those will all provide a level of confidence and comfort. The question is that enough to then help rally and sort of drive the bottom of the market and then help scale the market going up after that?
All right. Thank you for all of your comments. Is there any question before we wrap up? Any more questions before we wrap up? All right. I think that pretty much covers it for this session. So Oliver, Ivan, Stefan, if you have any final comments, don't hesitate to do them now, and then we can close up for today.
Yeah, I don't think go ahead.
Yeah, my only comment is just to say thanks a lot, everybody. If everyone's got any different opinions, any questions, any comments, please do reach out to us. You've got our Twitter handle @Truflation. You've got Telegram @Truflation as well, or go to our website if you want to do that, and connect us by emails. But please do reach out for us. We're constantly looking for greater feedback, commentaries that you ever have, and also opinions on your forecast predictions or any things that you're looking for from us that we can help you with. But on that note, beyond what we've gone through, hopefully it was helpful. Look forward to catching up with everyone on our next podcast, which Aurelian will update you on, but I think it's on the 2nd of May for the Fed update.
Yep, exactly. So the announcement will come out on Twitter, and we'll remind it a few times before it happens. All right. So Stefan, you had something you wanted to say?
No, nothing. Just thanks everybody for listening. You found this useful. You have any suggestions on how we can improve it, what you'd like to hear in these casts? We're going to try and do a couple more around some of the core economic sort of milestones throughout the courses of months. And yeah, we would just love for suggestions on how we can improve this to better address what you would like to hear from these. Obviously, we're all looking for alpha and good opportunities, but either way, let us know, and we would love to optimize this to better meet your requirements and help us learn to drive better engagement. Thank you.
Right, thank you very much. So I'm not going to repeat everything that was said. Just one more thing that I will add is don't hesitate to go over to our YouTube channel at Truflation and subscribe. We have a few videos coming up in the next few days and weeks with some exciting announcements. So yeah, if you subscribe, you'll know about it and you'll get the alpha, like Stefan said. So I think we're going to wrap up for today. Thank you everyone for joining, and we'll be reconvening. We'll do that again next month at the beginning of the month. Thank you very much.
Thank you. Enjoy.
Thanks, everybody.